Good afternoon. Yes, this is the last panel, so I appreciate everybody being here. And I also know right now, I think Evan is going to be giving a keynote in 5 minutes, which is why I think a lot of people probably are going to be missing this panel. So all of the panelists here you guys have to drop some alpha for our DeFi degens here. So we really appreciate you guys being here. I'm Tracy Wang. I am a senior reporter with CoinDesk. And we have a wonderful panel about what will bring DeFi to 1 trillion. And I'm going to turn it over to you guys. And if everybody can just do, like a quick intro, your name, your company, your role. Let's kick it off.
Sure. My name is Rajiv Sawhney. I basically manage the quant and strategy for Celsius's DeFi portfolio. Yeah.
Hey everyone, Santiago. Used to be, been investing in crypto since 2012. Was at Parify, which we were probably the first DeFi-focused fund in the space, really active users. Left last year and now just managing my own capital, very active in the angel space and as an angel investor and in some DAO communities.
So my name is Abdullah Almezairee. My background is in tech. We started, I'm the co-founder of Kutla, which was in the works for 3 years, and we just launched 2.5 hours ago.
And I'm Luigi Demeo. I'm head of DeFi at Avalanche. So really began my career in traditional finance, was always in crypto since like 2013 or so, and got very involved in DeFi Summer and kind of had an opportunity here to try and grow out the Avalanche ecosystem. Been working to bring as many projects as possible and help, kind of grow this ecosystem as much as possible.
All right, thank you. So the first question, DeFi Summer 2020 really put, DeFi as a subcategory of crypto on the map. And just some figures, checked DeFi Llama like yesterday. Its TVL is around 212 billion. And it's around a ninth of total crypto market cap. And just to, this panel is about growing DeFi, and that's around, say, like half the market cap of SPY, the most liquid ETF. And so when we're talking about bringing DeFi to 1 trillion, it's basically like a 5x. Where do you think that growth will come from? From the retail side, the institutional side? DeFi kind of has this issue where it's a little bit too degen for the institutions and maybe a little bit too sophisticated for retail. And I think some previous panelists at the conference have, I think somebody went and said that they think that all of the retail capital that would get into DeFi is already in DeFi. So what are your thoughts on, where will that 5x come from?
I think it's threefold. One is Ethereum has been pretty expensive to interact, so it naturally blocks out a lot of retail users when you're paying $20, $30, $40, $100 fees for gas per transaction. And so in other blockchains, you see a path like Avalanche, Solana, you see a path where it's more accessible for retail. So that's one. The second one is, DeFi, there's an entire ecosystem that's been built. What's exciting now is you have a lot of users coming in through NFTs and gaming. And so, you're playing a game, you're earning SLP, you want to swap that. So you're using DeFi that way. So I think the second component is as more games launch this year that are more immersive, this whole play to earn movement, I think naturally you're going to use DeFi in the back end. And third, I think, is through institutions, which is user aggregators, your bank account. There's no reason why your traditional bank account will not tap into DeFi to capture yield, especially given how yields are in the global kind of macro landscape. And so, stuff like permission DeFi environments like Aave, I think are really useful and are going to bring in, 5, 10x the capital that we're seeing today.
Yeah, I mean, I'll just piggyback off that. I pretty much agree. But, in general, we need to see DeFi sort of bring on some of the traditional finance primitives that we have, right? So we need to be able to use DeFi as a bank. We need under-collateralized lending, which we really don't have, right? Where you have over-collateralized lending where you're using one asset to borrow another, which is nice, but you can't really facilitate credit expansion in the way that you want. And then on the institutional side, we're working on this in terms of an institutional DeFi subnet, which is effectively going to be a permission chain, a fully KYC chain, where institutions can be comfortable that they can participate in DeFi using all the same applications that they're used to using or that they want to use, but in a way that's regulatory compliant, and that they can ensure that they don't have issues in terms of AML concerns or KYB and KYC concerns as well. So the two of those things combined, I think, is where you'll see DeFi sort of change the market structure as it compares to traditional market, market infrastructure.
With the Celsius, I think, from our perspective, I don't think it's mutually exclusive, and I definitely think even on the retail side, there's still a lot of adoption on the DeFi, especially even if you're looking at sort of using a MetaMask and trying to just deploy liquidity into a V2 pool on Uniswap. For a new user, that's actually quite a daunting task to just figure out how that all works, right? And so from our perspective in Celsius, we're really bridging that gap. Our job is really to find yield in DeFi, and for many users, they want that abstraction out of it. So most of our users are just hodlers. They just use our app, and they buy coins, they put it on, and they get yield, right? And so for our experience, those users or those end users are going to be part of the narrative or part of the sort of transition and adoption of DeFi as well. Yeah.
So I agree with what you just said. It's not mutually exclusive. There's room to grow in both directions, right? Both institutions and retail. For institutions, that's when it's less clear to most people, right? Because we see institutions as these organizations which only jump in when there are guarantees, right? But there is a number for every institution, just like there's a number for every person in retail, right? They do a risk versus reward. When liquidity is deep enough, when the reward is high enough, they'll start chasing yield in DeFi. So it's just a matter of liquidity and risk versus reward. And with retail, there are still more people locked out of traditional finance in the world, and they'll naturally flow to DeFi.
Thank you. Let's talk a little bit more about DeFi within the context of the broader crypto market. And as crypto has grown in the past decade, it's it used to be all like Bitcoin dominant, and now we're seeing DeFi as a subsector, NFTs, the metaverse. And so DeFi TVL reached a peak in November. I think it was around 250 billion, and now we've seen approximately 20% drawdown. Maybe it's outperformed the broader crypto markets by a little bit. But I'm wondering, what are your thoughts on how DeFi interacts with the broader crypto market? And do you see a world where DeFi decouples from that, or are these protocols kind of at the mercy of what Bitcoin and ETH and all of these large market cap coins do? And also, it seems that a lot of the largest DeFi protocols right now happen to be stablecoin related. I mean, these are investors that are trying to get yield from a relatively safe asset. So your thoughts on that? Yeah,
look. Obviously, last summer, what you really saw was sort of, with basis in speculation, you had natural, buyers that are very bullish on crypto in general, and that sort of sustained a lot of the trading that happened in DeFi, right? And sort of sustained a lot of the yield in DeFi. And now that we've come off that sort of, risk regime or sort of a speculative regime, stablecoins are really where a lot of people are parking their capital because of the stability of the principal, right? And that's even coming off in the market, right? These cycles have been around forever, right? It's just how they manifest themselves, and right now it's manifesting themselves in sort of DeFi. Before it was maybe in Bitcoin. I think, into your previous point, I think you could find a world where you were already seeing it with NFTs. They're using that as collateral to then borrow different types of other digital assets, and so I think we may be in a regime or a sort of a paradigm where that all converges, right? Where you have NFTs that are used as collateral to then mint a stablecoin to then do work on another, protocol. So I think DeFi will maybe mend itself into other types of GameFi or other types of sort of platforms that are on blockchain.
Yeah. So in the long term, in the very long term, I think there is a possibility they will decouple. However, we have recent history to show us the way, right? Crypto didn't even decouple from stocks right now. When the Fed had their rush program, similar to Avalanche's rush, but when the Fed had their rush program, all of crypto rallied, right? We went from, we went all the way up to almost 70K in terms of Bitcoin. So we're not at the point where I see a decoupling right now between DeFi and the rest of crypto, because crypto still didn't decouple from stocks. So that's in the distant future for me.
Yeah, and I mean, in terms of decoupling, it's sort of tough, right? I think actually what you're going to see is more and more correlation as it relates to crypto and traditional market assets. And the reason for that is because a lot of the holders of traditional market assets in terms of credit funds or macro hedge funds and things like that are going to start owning crypto. Like they already have started buying and owning Bitcoin. And as they have that and becomes part of the portfolio construct, all the correlations start to go to one, as you look at risky assets versus non-risky assets. So I think we will continue to see crypto get merged into traditional assets. It doesn't mean they can't outperform, but macro in general always dominates. But as it relates also to kind of like DeFi, I think one of the things that we still need to see is a lot of improvement on tokenomics and real value accruing to these tokens. A lot of these tokens that have been created and sort of constructed don't exactly have the necessary value accruing to the holder. And they're not optimizing for the things that I think ultimately they're going to have to. So like fee generation and revenue and all the things that we wanted to move away from, but at the end of the day still rule. I think until we can solve for that, it'll be hard to see those tokens be super valuable over time.
Yeah, I mean, I would agree very much with that. I think in many ways, DeFi has been uncorrelated to the broader crypto market. I mean, a lot of these DeFi protocols are down 80% relative to ETH, just because it was very unsustainable Ponzonomics. And so, to your point, Luigi, I totally agree with that. I think most DeFi protocols haven't gotten it right, and I think we're still early. But look, I mean, I think ultimately value will accrue if there's a lot of utility in DeFi. It's just a matter of getting the value accrual right, but we'll get there.
So lots of us on the panel here have a background in traditional finance, and a lot of investors are turning to DeFi because of these high yields, especially given the macro environment where we're seeing negative real yields, inflation narrative, and in DeFi you can get 20% APY on a stablecoin, and so how much of this, kind of current interest in DeFi has to be kind of taken against this macro backdrop? And, do you view DeFi as a complement or a substitute to, traditional investing in the traditional asset classes like the equities, fixed income, et cetera?
So on the yields, we get this question a lot. I think it's quite interesting. DeFi is no different than any other immature market that over time starts with very high yields, and as it gets very efficient and saturated, it'll come close to or around the risk-free rate, depending on what the difference is in terms of risk versus that risk-free rate. So I do think it'll be here for a while in terms of high yields, because I do think that there's still a lot of obstacles for adoption. But I don't think that those yields are will be sustainably higher than traditional markets forever, right? It's all going to converge to a risk curve over time.
Wondering if you feel that the yields currently being offered, do you think they price in the risk associated with these kind of nascent protocols?
Yeah.
Are they fairly priced, basically?
Yeah, I mean, I definitely think that you can, if you look at the landscape of DeFi, you can see that the market does price risk in a lot of ways. I don't know how efficient it is, but there's definitely higher yields for more risky assets versus the safe ones. Like traditionally, to deposit your money on Aave versus some new protocol, you're going to get a much lower yield there because more money's there, right? So I do think that is going to occur and going to continue to kind of evolve in that way.
Yeah, just to add to that, I mean, I think you always need to factor in the staking yield, which is sort of the benchmark. That is the risk-free rate in this ecosystem. Think of the rate that you might get by staking the L1 token, Avalanche or Ethereum or ETH, I guess, as the Fed funds rate, if you will. It can't be lower than that by default. Otherwise, it sort of compromises the security of the system. And so I think that's always going to be the benchmark. So if it's 3-4%, then it's L plus that, right? But you're right. I mean, I don't think risk is being priced very efficiently in the system at all. And so, if you don't understand what the yield's coming from, then you are the yield essentially. And so we don't have a lot of Lindy in the system. We don't have a lot of insurance products. Hopefully, there are a lot of protocols in the works that are going to hopefully address this. So insofar as we don't have insurance products, I think the yields should continue to be quite high to compensate users for a lot of this risk that we're in many ways beta testers for this new financial system.
Yeah, and just to add to that, one thing that we're very hyper conscious of is sort of the insurance protocols that you mentioned, right? If you look at the competitive landscape of insurance protocols, obviously the major one is Nexus Mutual, but if you had to ask what their total market cap is, it's only 500 million, right? The second biggest one, Unslash, is at 18 million, right? The gap in terms of the market cap of some of these insurance protocols is massive. And so when you take a step back and look at that, you're just saying, yields in general, sort of the DGen community is very hyper aware of how they want to sort of attack these new protocols and earn yield, but in terms of insurance, in terms of fixed and floating, these type of products that are very natural in the traditional finance world still are pretty nascent in DeFi, right? So there's a lot of opportunity for these type of products to emerge, and from that will become natural yield, opportunities as well. Yeah.
The other thing in terms of yield also is a lot of this is an incentive program, and it's to increase adoption. So I like to think of it as like when Uber gave out free $30 rides to everybody. I think that's kind of also what you're seeing in terms of high yields. It's a way to kind of get users to adopt it. It's also trying to attract a ton of capital. So by virtue, that is not sustainable because it's front-loaded. So,
one thing I want to add is we get asked this question a lot, which is, okay, what happens when yields compress to closer to parity what you see in traditional markets? Does that defeat the purpose and the value proposition of DeFi? And I think it's absolutely not. You're stripping away all the cost structures that you have. So you underwrite a mortgage, that takes 20 steps in traditional markets. You can envision a smart contract that collapses that. And so when you're removing fat from a system, you're always going to be more competitive. And so I think that's really where, yes, to your point, earning interest is a very good incentive for new users, but in the long, kind of medium to long term, you're going to be a much more efficient system, so you're going to provide a lot of value to the user. And if rates are 25 bips higher than what you earn in a bank, that's still enough for people to come over.
Okay, so I think this is where I diverge a little bit. So it seems like I'm more of a DGen than the rest of the panel, but I've heard similar ideas since it was only Bitcoin, even before Ethereum. We said, okay, we missed the train with Bitcoin. Then Ethereum came, and then they said, that's it. Smart contracts will always be on Ethereum. And then ICOs came, and then other L1s, and the pie is not slowing down. The growth of the pie is not slowing down. Now, I agree on the very long term, the music will eventually stop. However, the game of musical chairs, I think, has a long life in front of it, right? We were talking about 40% yields, 50% yields. Barring the outright Ponzi's, there are some legitimate high-yield DeFi apps out there, right? Since DeFi started, you could choose any time in history, and you will always find there was a high-yield opportunity. So as long as you're hopping chairs, to continue on the analogy, you'll always find high yield, and I don't see that stopping anytime soon. It will eventually, but I think there's a lot more gas left in the game.
Yeah, just to piggyback on that, one thing that we found really interesting at Celsius is to obviously, where are the sustainable yields, right? And for one thing that we noticed was this sort of paradigm between sort of stable coins versus risky pairs, and this sort of shift in terms of, when speculation grows high, you see that shift to the risky pairs, and when speculation comes off, it goes back into these stable coins. And, these pools that are in DeFi that basically help to bootstrap that liquidity seems to be one area that we're quite keen on, because we find that there's this natural ebb and flow as the speculation comes in the market and comes off in the market. And I think that will always stay. As people speculate in the market and get bullish in terms of different assets, that will flow one way and then come back, right? And that natural ebb and flow will always remain, I think, in DeFi.
So the next question is about sustainable yield, and I'm seeing, a lot of you guys mentioned really great points. So Luigi, you had mentioned this basically new business model that we see in Web 2 all the time. It's kind of like subsidized growth, and eventually maybe the adoption will get there. But in the meantime, these yields are kind of like an intro, like a subsidized Uber ride. And we also have some people on the panel that are interested in forever musical chairs. And Santiago, you made a great point about how even if yields come down in a DeFi world, you're stripping out the middleman, so you'll always get kind of better bang for buck. And so, some of the more, the harshest critics of DeFi have called parts of DeFi straight up Ponzi's. And Luigi, you mentioned tokenomics and kind of needing further development on that front. And so, when we think about the long-term future of DeFi, what do you think is the single biggest, thing that can make it more sustainable?
I think so the point of, you can find Ponzi-like yields in traditional markets too. I mean, there's a whole capital structure that you can invest in. You can invest in junk bonds, and you can find pretty distressed assets that are going to pay you 30, 40, 100, 200% yield. So it's a question of, I think the novelty of DeFi is that you can continuously price risk in a very efficient, in a much more interesting way. You have new instruments by which you can express and capture risk, which creates new yield opportunities. The same way that Mike Milkman did junk bonds back in the 80s and did a whole boom of leverage buyouts. So I think that's what's really exciting here, which is now you can price all kinds of things through oracles and new mechanisms by which you can pretty much create entirely new asset classes in their own right. And so that's where the yield, I'm not arguing that yields, the opportunity to capture Ponzi-like yields, it's not a Ponzi, but it's eye-opening yield, 80% yield. They're always going to be there. That's not inherent to crypto. What's really interesting is you are going to have, more people are going to have access to these products, whereas historically it would be institutions that would only have access to these kind of esoteric credit default swaps or whatever. The question is the user aware of that? And does he properly understand the risk, which is kind of the point that I'm trying to make, is I don't fully think that normal users in crypto really understand the risk that they're taking on, which is I think what you're saying, Luigi. But I think yields are always going to be there because you're going to create, think about how, imagine the gentleman beforehand was talking about insurance products, and you have, weather data being constantly uploaded to the blockchain, and now you can create literally any type of market on top of that, and that creates a yield opportunity. And so that really just opens up a whole panacea of new products. So yield, the ability to capture, I wouldn't say Ponzi, because the word Ponzi gets used in this industry a lot, but very few people understand what a Ponzi is. But just because something is 100% APY doesn't mean it's a Ponzi. It could be sustainable. The question is it going to be actually, profitable, because you might not be pricing risk appropriately. But that doesn't mean it's a Ponzi.
So in terms of sustainability, crypto is a market, right? And markets cease to exist if they're not sustainable, right? They just fall apart. So even if, let's take the Avalanche Rush program, for example, some would say that's subsidized. Yes, but Avalanche itself would need to succeed long term in order to continue giving these incentives. Another L1 did a similar scheme, right? The money isn't endless. So even when we're talking about subsidized, it's in a self-contained, to some degree, ecosystem within crypto. So I think sustainability, definitely, crypto is here to stay, so DeFi is here to stay by extension, and it's just a matter of what part of DeFi is here to stay. Now, that's the trickiest question. That's the not million, not billion, probably $1 trillion question, right? What's gonna stay here long term? And the beauty of it is it's because it's permissionless, dApps are throwing spaghetti on the wall, and whatever sticks long term is gonna collect all the lion's share of the TVL.
I think the other thing that shouldn't be is composibility. The fact that, for example, Alchemix, for example, self-repaying loans, things that don't exist in traditional finance, you'll be able to do things much more efficiently, and that's also reflected in the yield, right? And so when you have these projects that can do auto compounding or more efficient compounding, or the curve wars, for example, so they're going to vote escrow tokens, and sort of you have a convex, and now then you have bribing protocols that fit on top of that. That all comes into play when you have that final APY, right? Is the efficiency of how the composibility allows you to basically reap the rewards. And so that's also something that does not exist in traditional finance, and that we can leverage in DeFi, and allows us to have these yields that just would never exist.
I mean, I think you also have to take a step back and kind of think about where the yields are coming from a lot of times. So, as it relates to a lot of protocols, what they're doing is emitting a token a lot of times to incentivize liquidity for some purpose. If it's a DEX, they want to incentivize liquidity such that slippage can be low enough and people can swap in that pool. And that's perfectly fine. But I talked about this a little bit yesterday. I think we need to see some changes as it relates to tokenomics, and one of the reasons in particular is a lot of these tokens act like equities from an economic perspective, meaning that they are attempting to provide cash flows and they provide governance rights. So that is in effect an equity in a lot of ways, except you own a protocol rather than a company. So if it acts like an equity, right, then we need to stop emitting these tokens every second like they're Bitcoin. This is something that really amazes me, that all these DeFi apps have literally copied the fact that Bitcoin was mined into supply. That's really not how you're supposed to kind of raise capital as a protocol. You should raise capital when you need to raise capital, or you should buy back your tokens when you don't need to, or when you have extra capital and the token is underpriced. So I think when we see dynamic emissions of tokens as it relates to more targeted liquidity metrics, that's going to be a major shift in DeFi, and that's going to completely change the landscape as it relates to how these things come into existence. Currently, if you're emitting 100 of your token every second, no matter what the landscape shows, that's a very, very inefficient way to be distributing an asset.
Yeah, and to piggyback off that, I think a lot of protocols, acting as sort of an equity, a lot of protocols need to think in terms of their treasury as sort of like a company, right? And a good example is sort of the MakerDAO hack, right? And then they had to basically emit more tokens to basically compensate for the hack, right? And I remember Hasu of Paradigm writing a great article about sort of diversification in treasuries and how they need to be more efficient in terms of how they manage their treasuries. And I think that is a part of the problem too, is that a lot of these protocols, they really only have their native token that they're emitting, and they don't really have a good way of managing in times of stress, right? And so they need to be cognizant of how they manage that, how they're going to be long-term sustainable, and what kind of assets that they want on their balance sheet, right? And that's all part of the equation.
Yeah, I mean, also they're emitting a token to a pool that potentially doesn't need more liquidity. I see this all the time. So you need to be more targeted in terms of where you're actually sending rewards. Otherwise, you're going to end up being super inefficient, and markets kill inefficiency.
All right, so I think this will be the last question that we have time for. So when DeFi first started, it was pretty Ethereum dominant, and now, especially in the past year, we've seen the emergence of new L1s. DeFi has really taken off on Avalanche, on other chains like Phantom, Terra, Solana, and we see on a lot of these chains the same core DeFi infrastructure projects, maybe a DEX, a lending borrowing protocol, maybe a derivatives protocol, and it comes with its own set of challenges, whether it be liquidity fragmentation, or also the same projects launching on different chains, or copy pasta projects. And so what do you think DeFi looks like in a multi-chain world?
Well, I mean, I think it's a good question. I don't really know the good answer to that. I mean, obviously, it was pretty scary seeing the wormhole hack. I think that would have set us back years if it were of, that you were sort of left wondering, does that leave Solana insolvent for a while? And obviously, there was a bailout. I do believe in a multi-chain world. I think some sort of application-specific blockchains that are better. There's a reason probably why options haven't really taken off in Ethereum. More intensive kind of DeFi functions are hard to scale when gas fees and transaction fees are quite high. So, a lot of things that have perhaps been tried in Ethereum will work in other high throughput environments like Avalanche or Solana. And then I think ultimately it's going to be the role of aggregators and or bridges to really facilitate this cross-chain interaction without the user thinking twice about it. In fact, the user always thinks, and the user aggregator usually just thinks in terms of the utility and the action that it wants to take, and you're just going to literally route to the most efficient chain. That's, I think, how we're going to be. If you want to swap, you might swap in Ethereum and Uniswap and deployment on Optimism. And if you want to use options, you might go to Avalanche or Solana. But the user doesn't really care. I mean, there's like no brand affiliation to the L1, if you will. There's more of a brand affiliation to the aggregator, be it the wallet or your financial institution. So that's how I kind of think from a user-centric perspective, if that makes sense.
Yeah, I mean, also, like, one thing that I think a lot of people forget is we only went multi-chain 8 months, whatever, less than a year ago. And if you think that the infrastructure is going to be developed in time while we're like realizing that this is something that people want, like, you're going to be sorely mistaken. This thing takes a really long time to build. We didn't even have Uniswap, like, what, 4 years ago or 3 years ago? So things have to get built on top of other products. And so in terms of bridges, for example, I don't think we'll be seeing mint and burn bridges as the final product of bridges. I know that Layer 0 is one that has come out, and I think a lot of people have gotten excited about that. So we'll be interesting to see kind of more implementations in the bridge landscape that allow native-to-native asset swaps and reduce a lot of the risk as it relates to money sitting in a bridge and being a hotbot for something that people can hack. So I think that, as it relates to the multi-chain world, I think you're right that people won't really know what blockchains that they're interacting with. I think that ultimately, whether it's Avalanche and its subnet architecture for app chains, or Cosmos and their zones, or I do think horizontal scaling as it relates to the blockchain is the right approach, and I think we'll see that continue to merge, and with that, the proliferation of bridges that connect them, but also inter protocol communication. So yeah, I think at the end of the day, it's going to be a lot of bridges, and users won't even know that they're moving from chain to chain.
Yeah, I'd have to agree with that. I think it's what we see in sort of Web 2 is I think will manifest itself in DeFi, and you basically will have your Facebook or killer app if it's your Anchor protocol or your Uniswap, whatever. But where you source that liquidity or how that gets routed, that will all be abstracted out from the user, right? And so the user just has a great user experience. How that manifests itself will be done through all these different L1s and L2s, but ultimately the user gets a great experience.
Well, the first thing I would acknowledge is that multi-chain is only going to get more multi-chain, right? We can't stop people building more chain, making it more heterogeneous environment. So with that being said, I'm more optimistic about like the gap between the chains, or the bridges that fill these gaps between the chains. And we seem to forget that in parallel there's a huge number of teams that are working on different problems, because while we see it as a last mile problem with you talked about I think you Luigi, about user experience, another team sees that as an opportunity, and they would like focus on that for a year or two and just focus on that product. So as an example, like bridges are a big thing right now. Avalanche is doing a lot, and for me at least, out of nowhere came a project. I have no affiliation with Stargate, but I'm a huge fan of good engineering. So I don't know, they were working on this, they said for 13 months or even more than that. And we were all unaware of that until we saw a URL and you can go connect MetaMask and use it. So we tend to underestimate the massive parallelization that's going on in crypto. So whatever problem you suffer from right now as a user, as a last mile problem, as a backend scalability problem, there is not one, two, but multiple teams that see that as an opportunity and are working on that problem alone. I think it just takes time, but I've been here since Bitcoin, even before Ethereum, and it never ceased to amaze me how like crypto it looks like it's lagging, it looks like it's stalled, and then it just leapfrog a whole set of problems, and then you're in a new world. So these are exciting times. There are a lot of challenges, but I can't wait to see what DeFi developers come up with next.
All right, and on that note, these are exciting times. We're gonna end this panel. Let's give everybody a big round of applause.